Big Market Debate, powered by Investonomics, an initiative by ICICI Direct. Joining me today is Mr. P.K. Agarwal, a market expert with an experience of over 3 decades, and Mr. Abhijit Phatak, Head Marketing and Business Development, Definedge Solutions. Welcome to the show, gentlemen.
Thank you.
Beginning with you, Mr. Agarwal, how will you define current markets? We have Nifty and Sensex ending at record highs. We have small and mid caps performing very well. Would you say that markets are overvalued? There's a bubble, or fairly valued? How will you define them?
I think all of it, because in parts, you see, the problem is that when we talk about markets, people talk of only index. And index hardly tells you everything about the market, because index is generally defined by 10, 15 large caps, whose value determines what the index would be. Now, if I talk, just to tell you why index is not a great idea to look at when you're talking of investing, at least from the medium to long-term perspective, is because this index has Nestle, which is selling at a PE of 80, and this index has GAIL, which is selling at a PE of 7. So index will tell you nothing. So please do not go by index. Index is absolutely no indication of where the opportunities in the markets lie. But having said that, markets are extremely stretched, overbought, richly valued, and absolutely crazy. My 45 years of stay in the markets, I have not seen 17 months of consistent rise. So this is something abnormal, and therefore abnormality never sustains. But having said that, I still believe there are opportunities in the market, and whether it is a good time to buy, I have always said this, there's always a good time to buy if you know what to buy.
Right. Mr. Phatak, what do Nifty charts and the Bank Nifty charts say at these levels? I mean, for Bank Nifty, 35,000 has been a critical support. For Nifty, we are at life highs.
Yeah, even on the chart wise, it is definitely stretched, but as long as the music is going on, we have to dance. So, I mean, there's no, we have to go by the levels, and as long as Nifty is rising, that means the market is still bullish. Only piece of worry is Bank Nifty has been seriously underperforming Nifty, and it is still just not showing any strength. And unless it closes above 36,500 on Bank Nifty, I wouldn't say it is still strong. Of course, it gives sudden moves by, last week it was HDFC Bank. Before that, it was ICICI Bank. Only one or two banks move. Then Bank Nifty moves about 500, 600 points and then comes back to the origin level. So, of course, it is still range bound between 34,500 and 36,500. So, unless it breaks out above this 2,000 pound range, it's difficult to say what will happen to Bank Nifty. So, like I said, we have to go by the levels.
Mr. Agarwal, what is your view on the BFSI space? Will you be a buyer in some of the banks and some of the NBFCs at these levels?
No, some of the NBFCs have run up too much. I don't know whether the index as a whole, as I said, Bank Nifty doesn't tell me anything. You could still find buying in this. But having said that, let me tell you this. Generally, in sector rotation, when we take a long-term view or at least medium-term view, according to us, the BFI sector or the banking sector or the financials must start moving up. Yes. So long as they are not moving up, I would not say that market has come out of their downturn. Right now, we are not in a downturn. So in an upturn, if BFSI is not moving, this is a cause of worry, actually, if you ask me, because they should have. So if they are underperforming, that means market knows something which you and I don't know today. Right. So though I would be a buyer of BFSI in the hope of the whole market again going up one more leg up, but since it has already moved up for 17 months consistently without a significant correction, therefore I think the entire knowledge that I have is being put to test. And so therefore I would wait and watch as of now, because all the pointers are indicating. So for example, market cap upon GDP in Indian stock markets is today 120%, which is very, very rare, very, very rare for happening. Okay. We are at the Nifty is at the top of its range, 16,700, 600 is same, according to me, is no difference. And India VIX is still down. What down? It's only 12, 13, which is meaningless actually. So
Yes.
this is not the sign of a runaway market. This is a dead market. So therefore, it is neither, according to me, it is neither the top nor the bottom. According to me, it is a very difficult market to understand. So in such a situation, what we generally do is we maintain a good portfolio and be ready for a surprise and tweak the portfolio as and when the need arises. And what they call as black swan event, which I think America, in America, every analyst that I talk to is talking about, perhaps tomorrow or day after. But to answer your question, yes, that is a sector which everybody should be in. Whether this is the right time to buy, try to look for some stocks which are value for money, and even if they are not, you can start a SIP. You can buy 5 HDFC Bank every month or something like that.
Okay.
So I think that's the only advice I can think of.
Mr. Phatak, as Mr. Agarwal said, that it's a difficult market, so everybody is cautious at higher levels. So is it the time to move to defensives? Do you like something in the FMCG space?
Actually, I'm not sure about whether the term defensive is correct, because at one point of time, a few years back, even pharma sector was defensive.
Yes.
But what has happened to Dr. Reddy and Pharma in the last couple of months? So that is no. I mean, the definition of defensive is, let's call it FMCG sector only. So in FMCG, again, HUL has given a breakout on the charts. Britannia is looking good. Nestle is looking good. So definitely, except ITC, which has gone to sleep for I'm not sure for how long. So unless that closes above 240, there's no point in looking at ITC on the charts. But HUL, Britannia, and Nestle are looking good on the charts. Even Dabur, actually.
Okay. Mr. Agarwal, as Mr. Phatak said that, we don't call, defensive space now, because defensive definition has changed. So let me talk about one more defensives, as we call them, as IT sector. With digitalization and with COVID scenario panning out, this is the sector which benefited the most. Would you be a buyer in this sector at the current levels where they have seen an enormous gain in the last 1.5 years?
Yeah, I think the word defensive has been, at least in the professional portfolio management, now we call it the places to hide.
Okay.
Need not necessarily be defensive, but where else to go? So yes, IT is one of those places where you can hide. But again, they have also run up quite a bit. For example, Infosys from 25 to 40 PE. But yes, I would still give it a shot. And as I said, I won't buy full hog. If I have to buy 100, maybe I'll buy 10, 15 today and then keep on averaging it out over a period of time, what we call as diversification over time. Because nobody can tell you what exactly is going to happen today or tomorrow or day after.
Mr. Agarwal, you were just talking about the high P that all these companies are commanding. But looking at the quarter 1 earnings, would you not be revisiting and recalculating the P for these companies? I mean, they had a good quarter.
Even if you do that, there won't be much difference. But from 80, they may come down to 75. That don't materially change the situation at all. See, Nestle may be the best company on this planet, but 80 PE means, you know what? 80 PE means your money will be returned in 80 years. Do we even understand the meaning of PE? Actually, a lot of people don't even understand. They think just a number. It's actually not. It tells you how expensive it has become. People only look at price, and particularly when you're looking at chart and you're looking at a breakout and whatever, you're forgetting that every investing decision has price and value, two components to it. Price is what you pay, value is what you get. If I pay 18,000 rupees for a share of Nestle, what I am getting in return is an asset for which I will need 80 years to recover my principal amount. I don't think I'm very happy with doing that. I don't know what the lifespan of an average Indian today is. So my suggestion is that yes, they have, and the reason why they become so expensive is because there was nothing else to do. So people have put in money in these stocks, and that's why they keep going up. But if you're talking of investing means when you're investing for 3 to 5 years and you're looking at a 15 to 20% compounding rate of return from your investments,
right,
it's certainly not the time to get into these stocks.
Mr. Phatak, anything you like in the IT space?
Yeah, like everyone knows, they have run up. In fact, over the last, not even, 18 months is fine, but even in the last couple of months, they have gone up like crazy. TCS, Infosys. But there are still some pockets. I mean, Coforge is looking good, and TCS, IT, Infosys have run up quite a lot. So maybe on a dip, not here definitely. And what I would like to suggest, if someone is not invested in IT at all, they can start SIP in IT, not all in at this stage. I mean, because over the next maybe couple of years, they can average out their price. Entering ITC, sorry, TCS at 3,700 might not be a good idea. That is what I mean.
Okay. Mr. Agarwal, how do you see the recent announcement by the government, the national monetization pipeline, expected to fetch us rupees 6 lakh crore over 4 years? Do you think this is a reality?
No, I think these exercises have been done for many, many years. This is not the first time. It might have been packaged together, different matter. Mm-hmm. There's nothing wrong with the idea per se. I have only two observations to make. First of all, this is a revenue exercise. This does not increase the size of assets in the country. It doesn't make country richer. It just makes the existing assets probably used more efficiently. That's about it. So in accounting terms, it's a revenue exercise. It's not a capital expenditure exercise. That's point number one. Point number two, the culture in government and culture in private sector is very, very different. And I can tell you from my experience when I was in Birla's, MRPL, Mangalore Refinery, was a joint venture between HPCL and Aditya Birla Group. And what a disaster it was. We had two MDs. One was MD Technical, which was HPCL, when we had MD Finance, which was our nominee, and nothing used to get done in that company ever. Okay. Eventually, it was sold for 2 rupees per share to ONGC. So there are n number of examples like this. Nothing. The point is that the idea is good. How would you retain an ownership and rent out an asset and give the freedom to the guy to do it when he's not the owner? When I rent out my house, I tell the owner that you have to be careful when you switch on the water pump, make sure it is closed. Yes. Because I am the owner. Because if the motor gets burnt, I am the one who is going to replace it. Right. So when the ownership is different, then the operating guy, it's not very easy. But I can only hope and wish that it succeeds. That's all I can say. But there are a whole lot of challenges in it. And that is, and then secondly, when you centralize everything in one scheme, one plan, which you call as NMP, the assets belong to different sectors, power, road, etc., etc., etc. Now, they are all very different businesses. They are all very unique in their own sense. They have their own nuances. They have their own nuisance value in certain ways. So a single agency in government will be able to appreciate and handle, for example, the disinvestment ministry. Will they understand the power grids, power lines? I am not very sure. So those are the issues involved. But as a concept, nothing wrong with it.
But will the concept really function? I mean, where are the buyers? Even for the companies where the government is ready to give up the ownership, like Air India, like other few companies, there are no buyers for them.
This is exactly what I'm saying. So right now, unless you increase the pie, in the sense, unless the demand comes back, see, okay, you give me a toll bridge. Now from tomorrow, I am the operator of the toll bridge. And suppose 100 trucks pass every day. Even today, 100 trucks pass every day. If I am very efficient, maybe I'll stop some leakages 10% here and there, and that's about it.
Yeah.
It won't turn around the country. It won't make a major difference in the wealth of the nation or in the lives of the citizens. That is the point I'm making. Even if it succeeds, as I'm saying, there are a whole lot of operational issues involved.
Whatever said and done, but the market is really, the PSU stocks are doing quite well in the trade now. Mr. Phatak, what is your view on the metal space? I mean, metals have been on a run from last 1 year. Tata Steel, JSW Steel, JSPL, I mean, more than 100% gain for all these companies. Is anything left for an investor who's looking for a fresh investment?
Actually, when I want to look at a sector on the charts, what I do is I look at that sector index chart as a ratio to the Nifty, and it's quite not a scary thing, but definitely if I look at the chart of Nifty metal on Nifty, that had given a top in the month of May, and again last month it ended. The high was exactly at that point, and that in the terms of chart is called a double top. So that is not a very good bullish picture as of now. So it only says that metals might dip further. So if someone wants to buy, maybe wait for a good dip, because this is not a time to buy metals, and because that breakout is not going to come immediately, because like other sectors, this is also very overrated sector, and instead of going all in, either start SIP or just wait and let them maybe Tata still do 1200, that kind of levels. Till then, not buy anything.
Will you be a buyer in the auto space?
Auto space is very oversold right now, so a technical bounce is definitely due. I mean, stocks like Maruti, Hero MotoCorp, even Bajaj Auto. So a technical bounce is definitely due, maybe 5 to 7%. But right now they are at a support level. I'm not sure whether they start a fresh bull run or something like that. But definitely in the month of September, a bounce is due in that.
Will it be because of the fundamental, like festive season being around and the demand picks up, fundamental side, or it's purely on the technical side that you're?
So my view is only on the technical side.
Okay. Mr. Agarwal, I know you are you are not that optimistic about the markets on the current levels, but any sectors that you think are going to perform, say in the next 4 to 5 years?
No, I am very optimistic on the markets. All I'm saying is that they're right now not offering a lot of opportunities. I would love to buy. The only point is there aren't very many points to get in. Now, my base case is like this. In the big picture, I am looking at an inflationary environment, because I think inflation is going to go up. The days of low interest rates are over, not only in India, actually globally. The long-term debt cycle is almost at the inflection point. So inflation is going to go up, and inflation is out of the bottle now. The genie is out of the bottle. So we have to plan for it. So my portfolio design would include the scenario that we have inflation on our hands in the next 2 to 3 years.
Okay.
And we are going to have low growth, because COVID is still not letting anybody come out of it so easily, and it's going to be very, very tough to bounce back.
Yeah.
As we can see, even in US, with all kinds of stimulus left, right, and center, they are still not able to kickstart the economy the way it should have been. So that is the given big picture. Now, in that big picture, what can perform? So let us see what can perform in this environment. So in this environment, what can perform are hard assets, because when inflations go up, hard assets start performing, which means real estate, which is in very bad shape right now in India, metals, real. Otherwise, if you want to diversify out of stock market, then gold. Now, these are the assets which will perform if this scenario, which I'm thinking, turns out to be true.
Okay.
The other way to do it is you do the same thing through stock markets. That means you find proxy for these assets in the stock market. For example, if I say hard assets, if I say gold, of course, gold is not traded in a stock market, but I can find precious metal proxies, for example, Titan maybe, or something like that, So this is the way to play the market. You first create a hypothesis, and then see how you can implement it, whatever environment it may be, whether index is 16,000, 17,000, 25,000, 5,000, doesn't matter. Okay. This approach stays. This approach is the constant approach that you first build. What we generally do is what we call as all season portfolio, and then we tweak it based on whatever we see on the way.
Mr. Phatak, what is your view on the Adani Group shares? I mean, they had a bad time 2 months back, but now they are recovering and bouncing back well. Anything that you like in these group companies?
Yeah, actually, both Adani Enterprises as well as Adani Ports on the charts are looking good. And I mean, a couple of months back when they fell quite fast, that time there was a big gap on their charts. So I expect Adani Enterprises has a resistance near 1570, 1580. So at least to that level, and above that, of course, it can go back to its previous high. Same way with Adani Ports. In fact, I am more bullish on Adani Ports. Of course, not at this level, but if it crosses and closes above 850, then I wouldn't be surprised if it goes all the way to 950 or maybe even 1,000. Of course, this is not a short-term view. This is over the next couple of months or something like that.
Mr. Agarwal, do you think China plus one strategy is going to play out for India well?
I think any policy with respect to China is always a question mark. So I don't know what to say on that. I think we should only focus on what is good for us, and we should focus only on that. China is a very difficult country to understand what they actually want, what they mean. and how they operate is still not very clearly known. In fact, the way they have treated their own entrepreneurs tells us that as so far as possible, we should keep them away from us. So I really don't know what we should be doing on this. But my sense is that we should only focus on. We have so much to do in our own country right now. What we need is a big thrust on the infrastructure and all. So we should forget about China plus and whatever minus whatever. It doesn't really matter for us. What we should do is focus on ourselves, because on a very serious note, we need to put in a lot of effort in reviving this economy that we are got into. And if my assessment of the situation, which I just said, that high inflation and low growth turns out to be true, it's going to be very, very difficult to come out of this difficult economic situation, because this is not a cash flow issue. This is a solvency issue. So we need to be very careful about it.
Talking about two stocks on the charts, Mr. Phatak, Reliance and Tata Motors. Reliance is now showing some bit of a strength. Tata Motors crossed 320, 325 levels, and now it is consolidating within a broad range. So do you like these stocks?
Between the two, I like Tata Motors more, because Reliance again has been range bound between 2350 and 2150 on the lower side, and it is almost approaching the higher end. Of course, before that there is a big resistance near 2270, 2280. So it has to cross that as the first step, and above that maybe it can go back to its previous high, which is near 2350 or so. But Tata Motors has sold off quite a bit from the high, and it is taking support at the 200-day moving average, which technically speaking is a good retest on the chart. So that was near 280, 275, and the recent low was 268. So of course, someone who is buying needs to have a stop loss below 265. But in the very short term, I wouldn't be surprised if it goes to 320, 330 again.
What is your advice for the new young generation who's entering into the stock market?
Yeah, the young generation is, I think, from what I see, is a bit impatient. That is the problem, and I hope not all of them are into trading, because trading is not a wealth creator. Everyone knows that. It has to be a long-term investment, and I also agree that this is not a time for a long-term investment. Of course, for both aspects, for long-term investment, you need to understand the fundamentals as well as the technicals, and for short-term trading, you must understand the technicals. So it is a good time to spend online. There are a lot of avenues to learn. So they must learn how to trade and how to invest, whether on the basis of charts or on the basis of fundamentals, and not go all in just because everyone else is buying. That might lead to a trap and a big disappointment, because they don't even know what is a drawdown of 30%. I mean, anyone who has entered last year has no idea what is a drawdown of 30%, whether they can digest it.
Right.
So that is very, for long term, they can start SIP. For short term, they need to learn trading and not just go blindly.
Mr. Agarwal, what is your advice for the newcomers who are entering into the market to make big money?
I think they must understand that they have to be more patient. They have to be more focused. They must have a strategy instead of just sitting on a computer in the morning and start clicking. I think the good idea would be to spend some time in understanding what they want to do and what is your goal. And, then, and after that, they can start investing in small shots, small quantities, small installments, so that in one shot, they don't invest the entire money. And I can tell you, if they do that, suppose somebody enters at the age of 30, and even if they buy at these peak prices, and if they keep those stocks for 30 years, they're certainly going to make money. So keep your shopping list ready, keep focused, and keep watching the market, but don't invest and don't trade every day. Only trade and buy when the right opportunity comes along. There's an old saying in Chicago, there is a bus every 3 minutes. So there's no hurry at all. Right. Just relax.
Thank you, Mr. Agarwal, and thank you, Mr. Phatak, for being with us. It was a pleasure speaking with you.
Thank you.
Thank you so much.